17th December 2019. Muddy Waters Research, the short-selling firm run by Carson Block, published a report on NMC Health. NMC Health was a FTSE 100 company, a healthcare business operating hospitals and clinics across the UAE, a stock that had risen over 2,000% since its IPO, a company trusted by institutional investors across the world. Muddy Waters said something was wrong. They were right. The scale of what was wrong was beyond what even they had imagined. NMC Health was founded in Abu Dhabi in 1975 by B.R. Shetty, a pharmacist from India who had arrived in the UAE with very little and built a healthcare empire: hospitals, fertility clinics, long-term care, distribution. By the time it listed in London in 2012, NMC was a credible, growing business with a real operational footprint. By 2019, it was worth over $8 billion. It was in the FTSE 100. Analysts had buy ratings. The growth story was compelling. The accounts told a different story, if you looked carefully. Muddy Waters did look carefully, and what they found first was cash. The cash balances NMC reported in its accounts were inconsistent with the capital expenditure it claimed to be making. A company that says it is investing heavily in building hospitals should have cash moving through the business at a certain rate. NMC's cash figures suggested either the investment wasn't happening or the cash wasn't really there. This is red flag 1 from our free guide. Link in the description. Profit and reported cash that don't correspond to observable business activity. Muddy Waters also flagged that the cost of goods sold appeared unusually low relative to revenue, suggesting revenue might be overstated or costs suppressed. As investigators dug in, first Ernst & Young, then a court-appointed administrator, a second layer emerged. NMC had disclosed approximately $1.9 billion in net debt. The true position was $6.6 billion. Hidden borrowings, off-balance sheet facilities, loans that had been taken out by the company or by related parties using NMC shares or NMC assets as collateral, without appearing in the consolidated accounts. This is red flag 3, debt that is significantly higher than disclosed, and red flag 6, related party transactions that aren't properly explained or consolidated. The founders and major shareholders had used their stakes in NMC as collateral for personal loans. Those loans created obligations that sat outside the formal accounts. When the share price fell following the Muddy Waters report, margin calls were triggered. The company was called upon to honour obligations it had never publicly acknowledged. NMC Health's UK-listed entity went into administration in April 2020. B.R. Shetty resigned as chairman. He has consistently denied wrongdoing. Ernst & Young, the auditors, faced questions about how they had missed $4.7 billion in hidden debt. Cash that didn't correspond to reported investment activity. Red flag 1. Hidden debt of over $4 billion. Disclosed position was less than a third of the true total. Red flag 3. Undisclosed related party transactions creating off-balance sheet obligations. Red flag 6. Receivables and asset values that couldn't be independently reconciled. Red flag 4. The guide is in the description. Free download. A FTSE 100 company, trusted by the London market, audited every year, $4 billion hidden in plain sight. Muddy Waters read the accounts. Anyway,